The S&P 500 snapped a 9-day winning streak today. The Dow dropped 620 points. Oil surged toward $100. But the real story started after the closing bell. Broadcom reported the most anticipated earnings of this cycle. Record revenue of $22.2 billion, up 48%. AI semiconductor revenue of $10.8 billion, up 143%. They guided next quarter to $29.4 billion in revenue, up 84%, and said AI semi-revenue would more than triple to $16 billion. The stock dropped 12% after hours. CrowdStrike reported a beat too. Revenue of $1.39 billion, up 26%, beating estimates. Record net new ARR, raised full-year guidance. The stock dropped 13% after hours. This is the pattern we identified last week with Palo Alto Networks and HPE. When expectations are extreme, execution is not enough. And tonight, two of the most important companies in the AI trade just proved it again. I am Daniel Reed. This is Market Lens. Start with Broadcom, because it is the most consequential report of this earnings season. Revenue of $22.2 billion, beating the $22.1 billion consensus. Non-GAAP EPS of 2.44, beating estimates of 2.40 by 5%. Adjusted EBITDA of $15.2 billion, representing 69% of revenue. Free cash flow of $10.3 billion, or 46% of revenue. The AI semiconductor number is the headline. $10.8 billion in AI chip revenue, up 143% year over year. Hock Tan said AI semi-revenue is expected to exceed $100 billion in fiscal 2027. The company also announced a joint AI infrastructure platform with Apollo and Blackstone to deploy over 20 gigawatts of compute capacity through 2028, with the first tranche of $35 billion launching immediately. The company disclosed multi-year customer agreements, a long-term TPU deal with Google, a 5-gigawatt agreement with Anthropic beginning 2027, a 1.3 gigawatt commitment with OpenAI in 2027 as part of a 10-gigawatt deal through 2029, and a 3-gigawatt partnership with Meta through 2028. AI semiconductor bookings in Q2 alone exceeded $30 billion. The stock closed the regular session at $401.22, up 4.7%. After hours, it dropped to approximately $353, a 12% decline. That is roughly $55 billion in market cap erased in 2 hours. Why? The full-year AI revenue outlook of $100 billion for fiscal 2027, while massive, was already partially discounted. Some analysts had modeled higher. The market wanted a bigger number. When a stock has tripled from its 2024 lows and is priced for perfection, a record quarter is not enough. It needs to shatter every ceiling simultaneously. Broadcom shattered most of them. The market wanted the rest. This is the same dynamic we saw in Palo Alto Networks last week. Beat on every metric, initial pop, then fade as marginal buyers step aside. CrowdStrike followed the same playbook. Revenue of $1.39 billion, up 26% year over year, beating the $1.36 billion consensus. Adjusted EPS of 1.10, beating the 1.07 estimate by 3%. Annual recurring revenue hit $5.51 billion, up 24%. Net new ARR in the quarter was $255.8 million, a record for a fiscal first quarter. They raised full-year fiscal 2027 EPS guidance to between $4.88 and $4.96 per share, above the $4.85 consensus. Full-year revenue guidance was raised to $5.91 to $5.95 billion, also above the $5.90 billion estimate. The stock fell 13% after hours. The issue is the second quarter guidance. CrowdStrike guided Q2 adjusted EPS of 1.16 to 1.17, which matched the 1.16 consensus. Q2 revenue guidance of 1.43 to 1.44 billion also matched estimates. After a stock that has rallied 60% in the past month, matching expectations is a disappointment. George Kurtz said CrowdStrike is mission-critical infrastructure for the AI revolution, securing AI from the GPU layer to the agent layer to the prompt layer. The thesis is intact. The ARR trajectory is intact, but the stock ran too far too fast into the print. When the guide was good but not spectacular, the after-hours selling was violent. The question for Thursday's regular session is whether buyers step in at these lower levels or whether the fade continues through the week. Palo Alto Networks reported on Monday night after our last episode. Revenue of $3 billion, up 31%. EPS of 85 cents, beating estimates. NGS ARR of $8.13 billion, up 60%. Raised full-year guidance across every metric. Today, the stock fell 6.3%. Palo Alto has rallied 61% year-to-date. The stock had already priced in the beat before the print. When the actual report met those elevated expectations, there was no marginal buyer left. The pattern is identical to Broadcom and CrowdStrike tonight. A beat that gets punished because the bar was set too high by the stock itself. CEO Nikesh Arora said Palo Alto has held 800 meetings with customers in the last 6 weeks to address rising AI cyber threats. The demand environment is real. The platformization thesis is intact. But at 166 times trailing earnings, the valuation leaves no room for error. And the company reported a GAAP net loss of $177 million due to acquisition-related costs from CyberArk and Chronosphere. Macy's reported this morning and told a completely different story. Comparable sales increased 3%, the strongest first-quarter performance in 4 years. Bloomingdale's comparable sales grew 10.2%, marking 7 consecutive quarters of gains. Blue Mercury comparable sales were up 6.4%. Adjusted EPS of 13 cents beat the 3-cent consensus by more than 300%. The company raised full-year net sales guidance to between $21.5 and $21.75 billion and raised adjusted EPS guidance to between $2 and $2.20. The stock opened up 3%. By the close, it was essentially flat at $21.80, up 0.6%. The market's logic. Macy's beat, raised guidance, and Bloomingdale's is a legitimate luxury growth engine. But gross margins slipped 30 basis points on tariffs. Fuel costs are rising. The consumer discretionary environment is tightening with oil at $98. The stock has already run from its October lows. A beat and a raise was good enough to hold the line, but not enough to trigger a major repricing. The contrast with CrowdStrike and Broadcom is instructive. Macy's stock had modest expectations priced in. It beat modestly and held steady. AVGO and CRWD had extreme expectations priced in. They beat massively and got destroyed. The reaction function is not about the quality of the quarter. It is about the positioning entering the quarter. The broader market context matters here. The S&P 500 dropped 0.74% today, ending a 9-day winning streak. The Dow fell 620 points. The Nasdaq dropped 0.89%. The winning streak was the longest in over a year and 1 day shy of the longest in 3 decades. The catalyst for the sell-off was geopolitical. Iran launched missiles toward Kuwait and Bahrain. The United States struck an Iranian military control station in the Strait of Hormuz. Brent crude surged to $97.81, up 1.9%, approaching the $100 threshold. The 10-year Treasury yield rose to 4.49%, up from 4.46%. Before the Iran conflict began, the 10-year was at 3.97%. The bond market is pricing persistent inflation from higher energy costs. The VIX closed at 17.21, up from 15.77 on Tuesday. Still low by historical standards, but moving in the wrong direction. The JOLTS data released yesterday showed job openings at 7.6 million, the highest in 2 years. The labor market is tight. The economy is running hot. Oil is rising. The Fed's next move is increasingly being debated as a potential rate hike, not a cut. This is the macro tension that sits beneath the earnings narrative. Companies are reporting record quarters. AI, infrastructure spending is accelerating at a pace that has no historical precedent, but financial conditions are tightening. Oil at $100 is a tax on everything, and the market is becoming brutally selective about which beats it rewards and which it punishes. 3 takeaways from tonight. 1. The perfection trap is back. Broadcom reported the best quarter in its history. 48% revenue growth, 143% AI semi-growth, a $35 billion infrastructure partnership with Apollo and Blackstone. The stock dropped 12%. CrowdStrike beat on revenue, earnings, and raised guidance. The stock dropped 13%. Palo Alto Networks beat across every metric and fell 6.3% today. When stocks run 60 to 200% into a print, the report must be not just good, but historically perfect. Anything less gets sold. 2. The consumer trade is bifurcating, not breaking. Macy's beat and raised. The stock barely moved. Victoria's Secret surged 47% last week. Dollar General beat and dropped. The premium consumer has room to spend. The value consumer is stretched. And the retailer that serves the luxury customer, Bloomingdale's up 10%, is the one getting rewarded. 3. Oil at 100 changes everything. The S&P 500 ended its 9-day winning streak today, not because of earnings, but because of missiles in the Strait of Hormuz. Brent crude at $98 is the single largest risk to the second half of 2026. It compresses margins, raises inflation expectations, and threatens the rate cut narrative that underpins elevated valuations. Broadcom and CrowdStrike prove the AI infrastructure build-out is accelerating. The business fundamentals have never been stronger. But the stock market is forward-looking, and right now, the market is looking past the earnings and seeing tightening financial conditions, rising energy costs, and a geopolitical landscape that is getting worse, not better. An AVGO at $353 after hours is a better entry than an AVGO at $401. But be careful catching falling knives after 12% drops. The selling often extends into the regular session. Keep your data sharp and your logic sharper.